The message was loud and clear from this morning's data, which is in many ways stagflation. And as much as there is an asterisk over that specific data, we had the government shutdown in Q4, so we will probably get a mechanical bounce back in terms of growth in Q1.
Do you see evidence of that now?
Yes. So the government spending, exactly. So government spending is sharply down in Q4 and is bouncing back in Q1. But overall, we're moving in that direction anyway. The topic of the briefing we just listened to pushes the US economy and the global economy towards the message this, let's call it stale data this morning was sending anyway. So even if you discount this morning's data, I think that's a trajectory that the economy is on now.
All right, want to talk the inflation data, stale or not. We got PCE, the Fed's preferred inflation gauge, coming in as expected, 2.7% year over year, up 0.4% month over month. But you still say that's high.
Yes, absolutely. And more or less the same applies. So there are, if you like, temporary, I think the word used to be transitory, right?
Right.
Reasons for that number to be high. Goods inflation was picking up. People were talking more about tariff pass-through that might well fade. But in the meantime, we're getting a very significant, not just energy price shock, but supply chain shock. And that's going to push inflation right back above the comfort zone for the Fed to come.
But speaking of transitory, isn't the oil shock transitory? Because this war will end. And so how does the Fed then look at that holistically when they meet next week to decide the fate of interest rates?
Yes, and it's a very good point. And generally speaking, I would say you get a supply chain shock, energy shock, inflation goes up, growth goes down. So probably as a central bank, you generally don't do anything. So even that tells you not to cut rates. But then secondarily, that looking through argument very much depends on the size and the persistence of the shock. So central banks talk about second round effects. They will pay a lot of attention to inflation expectations in particular. But in many places, not so much the US, but in many places, the market is telling you central banks actually will need to hike. So they can't fully look through this shock simply because it's going to be too big.
Well, there's 412 central banks reporting, their story, their narrative, if you will, in the next 10 days or so. I'm kidding, folks, but it's a very active time. What happens if they do raise rates?
Well, I would say the most interesting central bank in that cadre is going to be the ECB, because the ECB is...
You think the ECB out of this politics
for
raise rates?
For once, the short answer is yes, later this year. And the reason why it's interesting is the ECB is at pains right now to tell you that that's not going to happen, and markets are just ignoring it. So both inflation markets and rates markets keep on pricing European interest rates to go higher later this year, despite the fact that the ECB is telling you we're going to look through this.
So in the old days, Willem Bouter would lean over and say, Ebrahim, tell me what to do at Citigroup, and the iconic Willem Bouter, and it would be strong dollar now, DXY through 100. The yen's going to be a 160 here into the weekend for their institutions as well. What is the symbolism of a strong dollar here? A one-off?
I think it's, for the time being, a refuge. And you have the combination of two aspects. It was under-owned, but it is also, in the grand scheme of things, a much more self-sufficient economy. Commodity-rich, self-sufficient, not so reliant on global supply chains. So it is the US dollar that is the place of refuge. In developed markets, Canada and Australia still are resilient. And there are many other places, including Japan, that are very vulnerable to both the energy dimension and the supply chain dimension.
So is the US dollar the only haven at the moment?
Right now, it looks almost like it.
Yeah.
And even if you look across markets, one of the big problems with a stagflationary scenario is it's very difficult to find hedges. So you see bonds selling off across the world. That's a very challenging scenario, not just for central banks, but also for investors.
Because we're seeing bond prices or yields rise and stocks fall. We don't normally see this relationship.
That's exactly what...
You nailed that.
That's...
Oh,
the essence,
okay.
that's the essence
ding,
of
ding,
the,
ding, ding, ding. Okay.
It's the essence of the stagflationary scenario. We got a lot of that in 2022, which again was also a year where the dollar was a safe haven. It appreciated strongly. So you might find a theme to hide in, and that might be a defense theme. It might be a resource and self-sufficiency theme. But for markets as a whole, hedges are going to be in short supply.
Eric Schatzker emails in. We've been going back and forth. Once again, the Toronto Maple Leafs are just not getting it done. Here's the headline from Schatzker. Canada sheds 83,000 jobs. Unemployment rate rises to 6.7%.
That sounds
Ebrahim,
really high.
What would happen if we get 4.8, 4.9, dare I say a round number 5% unemployment? There's no fancy debate with Ebrahim Rahbari. They have to aggressively cut, right?
So wait and then cut, I think, is still a relevant scenario. We look at historical reference points. The 1990, that's more or less what happened. Then the Fed ended up cutting in 91.
Right.
So it'll be a slow response, and therefore, only tepid support for the economy.